Brent crude just hit $90 a barrel, and your crypto gains are getting wiped. The Fed hasn't even spoken yet. Friday, July 24th, 2026. Like and subscribe for daily market updates. Today's agenda: market snapshot, the oil shock, gold's dilemma, tech sector rout, crypto's weakness, week in review. Up next, the oil shock. For the record, WTI crude is lower on the day, down about 3%. For the record, WTI crude is lower on the day, down about 3%. Let's examine the current market figures displayed on your screen. Bitcoin trades near $64,000, reflecting a slight decline following a significant drop earlier this week. Ethereum sits just below $1,900, while Solana and XRP are also experiencing downward pressure. However, these struggles extend beyond cryptocurrency alone. The S&P 500 closed sharply lower at 7,480 points. Performance was even worse for the Nasdaq, which tumbled 2.5% to 25,138. What is driving this broad market weakness? Oil prices surged past $90 after Houthi forces struck Saudi tankers in the Red Sea. This geopolitical escalation has created a genuine fear of supply disruptions that could severely impact global energy markets and economic stability. Investors are reacting swiftly to these developing threats, causing volatility across asset classes from digital currencies to traditional equities. The connection between regional conflict and financial performance is becoming increasingly evident as traders adjust their positions based on new intelligence regarding shipping lanes in the Red Sea. Consequently, risk assets face headwinds, while commodities tied to energy security see renewed interest despite the immediate price spike caused by supply fears. Market participants remain cautious about further escalations that could choke off oil flows entirely. The interplay between geopolitical instability and market sentiment continues to define this trading session's trajectory as uncertainty mounts worldwide. And that rising cost of energy is crushing the safe place to store wealth right now. Oil just topped $100 for the first time in 2 months, but it's currently at 89.57 cents on Friday afternoon trading. Brent jumped about 7% after Houthi forces struck 2 Saudi tankers in the Red Sea, opening a second front beyond Hormuz with Iranian involvement suspected by intelligence agencies. With Iran rejecting a truce and threatening further attacks, the supply fear is exploding everywhere from shipping lines to grocery stores globally. This looks overdone to me because the war premium is living entirely in crude now rather than spilling into other sectors like airlines or shipping, yet despite rising freight rates. If gold is struggling, what about the tech giants that drive your portfolio? The twist that caught many traders off guard occurred this week. Gold surged above $4,100 on massive volume, but failed to hold those levels immediately after earnings reports hit the market. It slid back toward $4,060 per ounce by Friday close. Even precious metals could not rally, while oil sat near $90, a price point actively reviving inflation fears in the minds of central bankers worldwide. This dynamic creates a genuine dilemma for investors. Gold traditionally acts as an insurance policy against currency debasement, yet it remains tethered to real interest rates and dollar strength. The mechanism is clear. When energy costs spike due to global political supply shocks or demand surges, inflation expectations reset upward faster than anticipated by most economic models. Consequently, central banks feel compelled to maintain an in favor of higher rates stance rather than rate change toward easing policies that would weaken the currency further. September rate hike odds consequently jumped to 80% because investors now demand a significantly bigger reward for lending money when prices are high, and real purchasing power is eroding faster than anticipated by most economic models. This shift mirrors historical episodes in 1974 or the early 1980, where rising commodity costs forced central banks into painful raising interest rate cycles that crushed how expensive assets look relative to earnings, before policy eventually caught up with reality. For concrete investor implications, this environment suggests a difficult path for non-yielding assets like gold and bonds unless inflation proves sticky enough to justify higher nominal rates over time. The market is essentially pricing in a scenario where the Federal Reserve must keep borrowing costs elevated longer than previously thought necessary to anchor expectations. This means portfolios relying on capital appreciation without yield generation face challenges, while those holding short-duration treasuries or floating-rate instruments may find themselves better positioned against the coming unpredictable price swings as central banks struggle to balance growth. Support with price stability mandates in an era of persistent supply-side inflationary pressures driven by energy markets and global trade disruptions. But there is one asset that might surprise you as the market settles down tonight. The stock market today endured a brutal, broad-based correction as the Dow Jones Industrial Average, the S&P 500, and Nasdaq Composite closed sharply lower, driven primarily by earnings disappointments from major semiconductor firms that shattered optimistic growth expectations. This specific sector weakness triggered immediate profit-taking across the entire technology index, erasing hundreds of billions in market value within a single session, a phenomenon reminiscent of late last week's unpredictable price swings involving Nvidia alone. That massive wipeout set a dangerous precedent. Now we see the spreading of financial stress spreading rapidly beyond megacap giants into small and mid-cap names as investors flee perceived overvaluation. The mechanism behind this rout is clear. When leading chip makers miss revenue targets, it forces analysts to downgrade entire supply chains, creating second-order effects that ripple through software developers, cloud providers, and hardware manufacturers alike. Simultaneously, the broader big-picture economic backdrop intensified fears of a hard landing. Oil prices surged amid escalating Middle East tensions, adding inflationary pressure just as Treasury yields climbed toward 4.5%. This rise in borrowing costs further compresses valuation price-to-earnings ratios for growth stocks, making future cash flows less attractive compared to safer assets. Historically, such synchronized sell-offs often signal a regime shift where available cash in the market tightens and risk appetite evaporates quickly. For investors, the implication is stark. Defensive positioning becomes critical immediately. Holding concentrated portfolios in high-flying tech names without hedges leaves them exposed to sharp drawdowns that can take months to recover from. The market is no longer ignoring underlying health. It is punishing any stock whose earnings narrative does not align with rising interest rates and global political instability. So what does all this mean for your money as you close out the trading day? For weeks, Bitcoin insulated itself from global political turbulence, ignoring escalating war tensions, while other assets faltered. That resilience fractured today as the price slipped decisively below $65,000, marking a drop of approximately 2% from recent highs just before oil prices intensified broader market anxiety. The mechanism behind this breakdown is clear. Rising energy costs are compressing profit margins for tech-heavy portfolios and triggering cash crunches that force investors to sell riskier assets first. Ether followed suit with losses exceeding $1,900, while smaller altcoins suffered even steeper declines as the prevailing mood shifted sharply toward extreme caution. This rotation out of digital currencies mirrors historical patterns seen during previous inflationary spikes in 2013 and 2020, where crypto markets acted as early warning systems for raising interest rates rather than safe havens. The second-order effect is a potential re-rating of entire risk sectors if the Federal Reserve signals further rate hikes or balance sheet reductions next week to combat energy-driven inflation. For investors holding long-term positions in Bitcoin and Ethereum, this dip presents a critical juncture. Selling now locks in losses during what grayscale analysts suggest might already be the market bottom, provided central bank support materializes soon. Conversely, those seeking capital preservation should view today's weakness not merely as unpredictable price swings, but as a structural realignment of risk premiums across all non-sovereign assets. This suggests that until energy prices stabilize and cash conditions improve, digital currencies will likely remain vulnerable to outsized sell-offs driven by big-picture economic fears rather than their own fundamental utility. Let's wrap this up with the single most important view for your portfolio tomorrow. From July 22, 2026, the market narrative shifted rapidly as investors recalibrated gold expectations ahead of Friday's close. The core mechanism driving this potential repricing is persistent stickiness in real yields. When Treasury inflation-adjusted rates remain elevated without a corresponding surge in nominal demand, non-yielding assets like gold face an opportunity cost that erodes price support. This dynamic held firm today as the dollar index climbed 0.3%, reinforcing the inverse correlation between USD strength and precious metals pricing. However, the crypto sector revealed significant fragility under this same pressure. Bitcoin failed to maintain its critical $64,000 technical floor, slipping instead by 1.5%, a move that signals a loss of institutional confidence in digital stores of value during periods of dollar appreciation. Conversely, Ethereum demonstrated relative resilience, but remains vulnerable as it approaches the key psychological resistance level at $2,000. Breaching this ceiling would be necessary to trigger a broader sector rally, while failure could lead to further liquidation cascades from leveraged positions. Looking back historically, similar patterns emerged in 2013 and 2020 when real yields spiked alongside dollar strength, causing parallel sell-offs in both gold and major cryptocurrencies, before policy pivots reversed the trend. The second-order effect here is a widening divergence between traditional safe havens and digital assets unless monetary conditions ease soon. For investors, this week's unpredictable price swing suggests that holding solely in crypto may be insufficient for portfolio protection against real yield drag. Capital allocation strategies must now account for the possibility of an imminent repricing event, where gold absorbs available cash from riskier tech sectors if inflation data continues to justify higher rates. The window for action narrows as Friday approaches. Any failure by the dollar index to break new highs could suddenly unlock a massive buying wave in commodities, whereas continued strength would likely force another round of paying down debt across alternative asset classes before market close. Tonight, oil prices surged past $90 following Red Sea attacks, which immediately pressured airline stocks and grocery margins. Consequently, airlines faced margin compression, while gold failed to provide safe haven support as bond yields climbed toward 4.5%. Bitcoin slipped below 65,000, and the Nasdaq tumbled 2.5% due to resurgent inflation fears. Investors appear risk-averse today. However, expectations for a repricing of gold should emerge by Friday if real yields remain elevated or unless the dollar index breaks higher first. Thanks for watching Market Pulse Daily.